Hey everyone, Gen X guy here today. Hope everyone's having a wonderful day. Thought I'd shoot a little video here and talk about why I'm investing in high risk assets. Why it's important coming up here this week, actually. I don't know if most of you know this or not, but this Wednesday, the Fed, we believe, they're going to drop interest rates. Some think it's going to be a quarter point, 25 basis points. Some people think it's going to be 50 basis points. And the percentages look pretty good, percent chances that's going to happen. With unemployment being as high as it is, and then revising the unemployment numbers, they recently revised nearly a million jobs from over the past year that was misreported. So that, in combination with inflation staying fairly tame and or slightly coming down just slightly, that's signs for reducing the rates. So what happens is when they reduce the rates like that, it causes people to be a lot more risk on. So when the rates are high, people tend to put their money in lower risk places such as money market funds. And I don't know if you're aware of this or not, but there's roughly $7.3 trillion in money market funds right now. Well, that's money that's just sitting on the sidelines that's in low risk, earning anywhere 4.25% right now. One time it was at over 5%. Within about a year ago, within the last year, and it's when they lowered the rates back in the fall, it causes people to be a more risk on appetite, and so we're about to be in that situation again. So when lower yields on money market funds occur, money wants to make yield. It always wants to search for more yield, but it also wants to balance risk versus reward, right? So why would you want to go put your money in a lot of high risk when you can earn a 4 or 5% return on your money with little to no risk? Of course, nothing is zero risk, right? There's always some risk, but generally speaking, when you have your money in a money market fund, it's pretty it's pretty safe. So now that we're in this lower rate environment, that's a stimulus type of event, and it really creates economic growth incentives. And when that happens, investors, retail investors as well as institutional investors, they start looking to deploy their capital, their money, out of lower risk to things that are going to attract higher yield. And I believe that we're lining up for that to really happen. And we're about to see on Wednesday what's happening. So, what am I doing? I'm high risk, and I have been high risk forever. I have always been a high risk investor. I just, and it's done well for me. I've been high risk since I was the day I left college and started earning income and started investing. Now I do have money in money market funds that I use to is a savings emergency. But money, and we discussed this the other day, and I think 2 videos ago, that you really don't want money, just a lot of money sitting in a money market fund. You want it working for you, and even though it's safe at 4%, there's still stuff out there that's returning much higher than that. And you can be in stocks that throw off dividends and they go up in value, the stock itself. So not only are you getting the yield off the dividend, but you're also getting the growth of the stock. So I've always been a high risk investor. And so when I say high risk investor, what does that mean? I typically invest in small mid cap tech stocks, a little bit of that, in tech stocks in general. I don't invest in any other really stocks, and I have a reason for that, and I'll explain it. But the main thing I invest in is crypto. Crypto is, and this is, well, I'll get into crypto in many more videos down the road, but I'm a huge believer in crypto. Is a Gen Xer, it is, when I discovered crypto about 4.5 years ago, my eyes were wide open. Being in tech for so long and getting into money and investing my money, when I discovered crypto, the light bulb moment really went off for me. And so a major chunk of my money is invested into Bitcoin and other crypto. And so it just has the highest rate of return. If you would have put your money in Bitcoin alone over the last 5 years, there's nothing that's outperformed it or even come close. Not even close. It's unbelievable how well Bitcoin has done, and it's just tech in general. You look at all the different sectors that you can invest in, right? There's what is there about 12? There's information technology, there's consumer discretionary, there's utilities, there's the energy sector, there's communication, there's consumer staples, real estate, financials, industrials, healthcare, materials, and then now cryptocurrency being the new asset class. And I think you're going to see it absolutely be a new asset class. As of today, crypto is about a 4.02, just over $4 trillion sector space. And I think you're going to see it be its own, classified more regularly as its own asset class. But what's interesting about these sector performances, just over the last 10 years, information technology has blown them all away. So this whole mindset that people have had, well, you got to be diversified. You need to be diversified. No, you don't. No, you don't. And I did a video just yesterday about tech. Tech always wins. And so when you look at this, and I'll try to put this up on the screen, this performance chart, just covering the past 10 years. This isn't even talking about the last 20 years. It is just as good. So you're looking at the return on the S&P information technology sector over the last 10 years has returned 702%. 702%. If you would have just put your money in tech alone, you would have 8x'd your money in the last 10 years. The next closest here that I'm looking at is the S&P itself, which is 237%. Then the next is consumer discretionary at 220%. And so you could say, well, my financial advisor, or I've always been told that it's, you need to have a nice blend. You got to, when one is down, the other one makes up for it. No, that doesn't make, why? Why would you do that? Why wouldn't you just put your money in over the last 10 years? Sure, tech's going to have down days, down months, down several months or what have you. There's cycles. Everything has a cycle. But overall, if you're in it for any sort of period of time, just keep it there. And it's done well. Even over 20 years, nothing has beat tech when it comes to stock. And even look at crypto. It's crushing it. So I only put my money in that. When it comes outside of the 6-month emergency fund savings, all my money's in tech. I don't put it into, your good old American staple, your Home Depots and your Coca-Cola and all that. That stuff doesn't go anywhere. It's not going to make me any money. I want to put my money in invest my money in something that's going to get me a real return. And as you say, well, it's more risky. When you put your money in tech, it's more risky. Is it? Is it more risky? 10 years of 702% return? Over 10 years? That's pretty good. And even going back 20 years, I think it's like 500% over 20 years, because we may have had a little dip down in there. But if you have kept it in there all this time, it's unreal. And I'll do this in another video. If you would have put your money into QQQ, the tech ETF, back from its inception, like $100 a month, the amount of money that you would have made from then till today is unbelievable. The return of the money, the amount of money that you would have made over that time. So I'm all high risk, guys. That's just, and I will be, and I'm going to stay that way, because I haven't had any evidence or proof that going any other way is better. Having my money invested in tech and crypto has done well. Now we've been in a bear market with crypto up until the last year or so. I mean, we've turned and been in more of a bull market, and we're about to be in bullest of bull markets. When they lower these rates, you better hang on. This crypto market's about to blow up, especially the altcoin market, and we'll get more into that later. But yeah, guys, high risk is where it's at, and that's why I invest in it. But again, this isn't financial advice. You do you at the end of the day. But if you look at the numbers and you say to yourself, why am I in this other stuff? Why am I in utilities? Sure, does it have good times? Sure, it has good times. Does the industrial sector have good times? Yeah. Does healthcare have good times? Sure, it does. During the pandemic, healthcare stocks did well during the pandemic. But over the course of the last 10 years, this only had a 100% return on your money, a 2x. Meanwhile, tech has had an 8x return on my money. So where are you going to put your money? If I told you right now, just take the sectors out of it, you give me $10, would you rather have 20 return or 80 return? What are you going to say? Give me the 80, right? So that's my thoughts on that, guys. And we'll talk more about these type of things, investing, high risk. I'm a high risk guy. I always have been. It's done me well. But everybody has their own risk tolerance, and you have to know yours, and mine is high, and it always has been high, and it always will be high. And we'll talk about the money supply and more of my theories and understanding of why this really makes sense, and why you really need to be in high risk. There's other reasons why too. But anyway, we'll do this quick video. Appreciate your time today. Like the video, subscribe, and hey, this channel, it's new. I'm figuring it out, guys. I'm not the most seasoned broadcaster in the world, but I'm trying, and I'm trying to help you guys out, and trying a little mix of everything. I've done a lot of things in my life, and maybe I'll tune this up to get a little bit more fine focused here. But appreciate your time and watching the video and giving me a chance and being patient with me. Like the video, subscribe to the channels. All that's helpful. Comment, please, if you want to get some ideas, or you want to hear more from me. Be glad to do it. Thanks. Have a good day. Gen X guy out. Bye.